Hi, ladies and gentlemen. Welcome to SA Accounting Academy. Here's a short clip on one of our previous webinars. I hope that you really do enjoy it.
Hi, everyone, and welcome to the CPD learning activity hosted by SA Accounting Academy and presented by myself, Anton van Wyk. On the menu today is, of course, IFRS 11, dealing with joint arrangements. And this is a relatively new reporting standard. I'm saying relatively because it's been around for a few years, but I know that many people are not fully aware of or comfortable with the content of IFRS 11 joint arrangements, and therefore I thought it a good idea to have a learning activity about this particular reporting standard. Some background information about myself. If you are interested there, you can have a read on the slide. And then I would like to just set the agenda for us for this webinar. Firstly, we're going to be doing a quick recap on the concept of control from IFRS 10. The reason that we're doing this, obviously, is joint control, one of the words being control. So you have to be able to establish control before you can decide whether there is joint control. So control is actually a very important concept to go and visit or revisit. Unfortunately, we cannot talk about the entire IFRS 10 because that is quite a long and complex standard. And we've already recorded a previous webinar or CPD learning activity on IFRS 10. So if you are interested in finding out the nitty-gritty about deciding whether there is control present and then taking the next step to decide whether there's joint control, the control component has to be studied in terms of the standard IFRS 10. So I'll quickly recap just the absolute crux of IFRS 10 so that we can take it into IFRS 11. Then we'll be looking at what the objectives are of IFRS 11. What is it that we want to achieve by studying this particular reporting standard? Then understanding the classification of joint arrangements and how that actually helps us to understand the accounting thereof. So firstly, we have to be able to decide whether we are actually dealing with a joint arrangement, because not any arrangement between two parties will automatically be a joint arrangement. There are certain characteristics that must be present and things that we have to test for in order to understand whether we are dealing with a qualifying joint arrangement. Then we'll be looking at the accounting treatment of joint operations and the accounting treatment of joint ventures. And that basically, ladies and gentlemen, is the content of IFRS 11 on joint arrangements. So let's make a start. If we quickly have a look at IFRS 10 in respect of only the concept of control, IFRS 10 is inextricably linked to the other IFRSs and IASs that rely on your ability to determine whether there is control. And as you can see, separate financial statements in IAS 27, IFRS 11, joint arrangements, the topic that we're doing in this webinar, IFRS 12, how to disclose your interests in other entities, IFRS 3 on business combinations, IAS 28, investments in associates and joint ventures, and IFRS 9, financial instruments. Now, the link between these standards from this angle obviously lies in the degree of influence that one party exercises over another. Now, obviously, when there is control, that party becomes a parent if that control is exercised exclusively. When two or more parties exercise joint control, then we have the possibility of a joint arrangement that falls within the scope of IFRS 11. And then, of course, when you have significant influence, which means that you can disprove control or joint control, significant influence is probably your weakest influence for which there is a separate standard. From a group reporting point of view, unless we look at a simple investment, for example, a 5% investment in the shares of another entity, in case of which that investment will obviously then be accounted for in terms of IFRS 9 as a simple financial instrument. All right, so a financial asset. So when you have significant influence of the three defined types of influence being control, joint control, and significant influence, obviously IAS 28 is then affected with the significant influence making it an associate. All right, now what I want to just point out is that IAS 28 also contains the accounting treatment for investments in associates and joint ventures. Now that never used to be the case. IAS 31 existed, and IAS 31 has been superseded by IFRS 11. But IAS 28, in respect of the equity method, now relates to associates and joint ventures, not joint arrangements. So it's important that you see the title of IAS 28. That standard deals with investments in associates and joint arrangements that are classified as joint ventures. Right. And later on in this webinar, you will see that we equity account joint ventures. And if you want to understand what equity accounting is all about, the nitty-gritty, then IAS 28 is the standard that you would consult. So IFRS 11 then actually refers joint ventures accounting treatment to IAS 28 so that the equity method can then be applied. All right, so just to update your knowledge on control, what is control now? It used to be, a simple definition where it said, the ability or the power to govern the financial and operating decisions of another entity. So the focus was on the word govern. So the concept of control has been built out, and those attendees that actually also attended the webinar on IFRS 10 will remember that an investor controls an investee when it is exposed to, or it has rights to, variable returns from its involvement with the investee, and it has the ability to affect those returns through its power over the investee. So you can see that there's been significant elaboration on the definition of control, and we discussed this in great detail. So that exposure or right that you have to the variability of returns. So when will returns actually be variable? When the returns are fixed, even the company's performance can still be the variability relating to those returns. So if the variability is established by the fact that the company's non-performance could lead to the fact that fixed returns cannot be settled, then those returns are also variable. Then the company or the party that is assessing control needs to establish what is its power over the investee, and it doesn't end there. It then goes one step further, and it says you have to have the ability to use your power to actually affect those returns that are variable. So if the returns are not variable, your ability and your power effectively mean nothing to you and do not give you control. Then you have to look at your power. How do you actually establish power over the investee? Is it through voting rights? Is it through contractual arrangements? Is it by mutual agreement, etc.? That's the way that power could be established. There we take into account things like voting rights, mainly, but also potential voting rights, things like that. All right. So as long as the rights that you have that give you that power over the investee are substantive rights and not just protective rights, you'll be covered from a power point of view. Then how do you actually have the ability? Where does the decision making in that entity take place in respect of its relevant activities? And once you've established where the decision making takes place, then you need to determine whether your power is actually realistic and does it give you that right or that ability to have an impact on the variable returns of the investee there where decision making takes place. So Then obviously one will have to determine what are the relevant activities of an entity. One would have to determine how are the relevant activities actually directed.
I hope that you enjoyed that video. For more of our webinar videos, go to www.accountingacademy.co.za. Thank you and have a lovely day.